Welcome to Friday, everyone. Are you feeling happy for the weekend coming up? So yeah, it's a sobering thought that after this Friday we only have 3 more Fridays together. You gotta be here like a Friday of finals week or Friday right before finals week can be great, and then finals week Friday can be like, you know what, I'm kind of missing auditing already, and you're gonna email me and says, Dr. Barnes, can we get together on Friday afternoon? I'm gonna say, you need to fly on your own now. All right, you need to fly on your own. I'm just gonna have to let you go, and yeah, that's the dream anyway. Most people are just gonna be kind of like, oh, thank God, no more Fridays, no more auditing in the afternoons. Yeah, that's fair too. Excel assignments over and done with. See a lot of relieved faces in the room, and so hopefully that went well. Uh, I always kind of worry about the drama that I associate with that. I don't want to put like so much drama on that. It's like you have to do this. It's that life or death situation, but I do want people to take it seriously. And so I think this class did a pretty good job of that. So we'll see what happens on that. Um, let's see. Coming up. Oh yeah, there's something I wanted to mention. Yeah. I knew there was something I wanted to mention before we got to homework. So we have presentations in the week of week 15. We have exactly one group that has selected a presentation topic, and so 3 more groups need to select presentation topics. So I know one group has said that they were going to tell me the presentation topic, but their representative said, and I quote, "I don't remember what it is." So yeah.
I sent you an email.
Okay. All right. Did you just send me an email?
Mhm.
Okay. All right. Well, that works out well. Yeah, we now have 2 groups of presentation topic. What presentation topic did you select just for reference? I don't remember. Oh, sorry.
Current technological change.
Current technological trends. So data and analytics and auditing and current technological trends have been selected. So any of the remaining groups, please select from among the remaining topics. There are 4 still great ones, including SOC reports. Everybody loves SOC reports, all right? No, not everybody loves SOC reports. Only Dr. Barnes loves SOC reports because he's a control freak. But yeah. So keep that in mind, get those to me. Let me know what your presentations are going to be for your group. Start thinking about those presentations. Don't wait till like the week before to start saying, all right, let's start allocating responsibility. I know you're very busy, but start thinking about those now, please. All right, we have homework to go through, so let's get cracking on that. Starting out, question 1215, which of the following procedures would most likely be considered a weakness in an entity's internal control over payroll? So let's just walk through these and see what we think about weakness. A voucher for the amount of payroll is prepared in the general accounting department based on the payroll department's payroll summary. What do you all think about that? Is that an appropriate approach for a payroll? That seems like something that'd be appropriate. So I don't think that's a weakness of internal control. Payroll checks are prepared by the payroll department and signed by the treasurer. So they're prepared by the payroll department, then we're talking about a recording function, and signed by a treasurer. The treasurer is probably authorization function. So proper segregation of duties there. So I feel pretty good about that one. The employee distributes the payroll checks, returns unclaimed payroll checks to the payroll department. Okay, so whoever's distributing the payroll checks has custody of those payroll checks. But when they're not, when they remain unclaimed, he just basically says, "Hey, you payroll departments, the department's responsible for recording. Here's some checks for you." Is everybody seeing the problem here? Remember, we just said payroll is a recording function, and now we're giving them custody of the checks. So they actually have both custody and recording. So could somebody in payroll make a fictitious check and say, nobody's ever going to claim this. They're going to return it to me, and now I can have my own paycheck. I can have a separate paycheck. That's the theme of Superman 3, by the way, if you've never seen that classic. Yeah, the old Superman with Clark, or with what was his name? Why am I blanking on his name? Christopher Reeve. Yeah, Christopher Reeve. Yeah, the Superman 3 with Christopher Reeve and Richard Pryor in it. And also Office Space. That's not 1990s classic. Yeah, additional payroll checks. Personal department sends employees termination notice to the payroll department. That's probably something we should note. They would want to know that if there's any paychecks that are unclaimed, that they are for a valid period, and they're not getting additional payroll paychecks for people who should not be claiming them. So that seems like a proper control in that area. All right, question 1218. By the way, C is the answer. Just make sure everybody caught that. C is the answer. We don't want to mix or recording and custody. Purpose of segregating the duties of hiring personnel and distributing payroll checks is to separate what? So let's just walk through these both steps, okay? Hiring personnel, what did we classify that? What functional area did we classify that when we were walking through segregation duties? I'll give you a hint. It either starts with a C, an A, or an R. One of those three. Okay, I'll give you a hint. It starts with an A. Authorization of transactions, or authorization of transactions, hiring of personnel. So our authorizing a hiring transaction. Distributing payroll checks. We just talked about that. So having access to the payroll checks means you've got custody of the payroll checks. So separating authorization from custody. Is there an answer that says separating authorization and custody? Wouldn't that be convenient if that was the case? That would be my explanation for this answer. What do we got to say? Authorization of transactions from the custody related assets. Yeah, that seems pretty logical for me, given our situation. So I'm gonna say C is our answer again. All right, question number 1221. All right, I both love and hate this question. It's one of those things that I hated when I first started answering it. Now I just love it because it's, you know, you learn to love the things you hate, I guess. Which of the following audit tests would most likely be used to test the occurrence assertion for payroll transactions? So we're talking about testing existence occurrence. So which of the audit tests would be appropriate for testing existence occurrence? So trace a sample of timesheets to the payroll register. So timesheets going to what recorded in the system. Is tracing being used correctly in this scenario? Are we going from source documents to the system? Yes, okay, tracing is being used correctly. So if it's being used correctly, then we're talking about completeness, so it's not existence occurrence. Recompute the mathematical accuracy of a sample of payroll checks. Recomputation can only be used for what type of assertion? VAA, okay, we're testing VAA. Tracing a sample of payroll checks to the approved timesheet summary and the master employee list to verify validity. So payroll checks, these documents that are generated at the end, we're going to go to the timesheets and then the master employee list, which are the kind of the source documents for that. So we're moving down. Is tracing being used correctly here? Tracing is not being used correctly here. What is the actual term for this process that's being used? It's vouching. We're talking about a vouching test here, which means that we're testing what assertion? Existence occurrence. We're testing existence occurrence. So this is the appropriate answer. Though if you're going to say, Dr. Barnes, they use the word trace, that's not fair. Okay. I'm going to tell you guys right now, life is not fair. Okay. Especially as it comes to questions in the auditing class. Okay. So yeah, you're going to say it's tracing, but it's not tracing. It's actually vouching, which is a test of existence occurrence. Then we have D, test a sample of timesheets to the presence of authorization. That's going to be a control that's related to, or it's going to be related to the controls test. But we would say that that was going to be actually verifying authorization, which is not a real assertion, but it's not existence occurrence. So C is our answer. Is everybody happy with that answer? Does everybody just get angry with it like me? Just like, how dare they use tracing when they don't mean tracing? Yeah, get ready for it. Get ready for it. I will not do that to you on the exam. Fair warning, but I can't tell you what that you may not encounter in other scenarios in your life. Okay. Especially those of you who are planning on sitting for the CPA exam, which I'm assuming is in several of you. All right, 1223. The auditors most likely to perform substantive tested details on payroll transactions and balances when. All right, so cutoff tests indicate there's a substantial amount of accrued payroll expense. Okay, so would that be a situation where we're most likely to perform substantive tests? Well, that's actually a little bit of a misnomer because if we're performing cutoff tests, we're already performing substantive tests. Okay, so you could technically say yes because we're already in the substantive phase. But I think the question that's angling here is like, what would cause us to perform more tests of substantive details? So let's hold on to that one because I don't think that's necessarily an appropriate answer, even though you would want to say this is a substantive test. The level of control risk relative to payroll transactions is set at low. What does it mean when control risk is low? What does that most likely represent for risk and material misstatement? The risk and material statement is going to be low. Okay, if risk and material misstatement is low, detection risk is high. Detection risk is high. If we have high detection risk, is that a good thing or a bad thing for us? That's a good thing. It means we can tolerate a lot more risk. It means we have to do less work over payroll transactions. So B is not the correct answer. Substantive analytical procedures indicate unusual fluctuations in recurring payroll entries. So we do some substantive analytical procedures. And what we find is something completely unexpected. Saying, wow, we have fluctuations here that we did not expect to occur. Now, if you're an auditor in that situation, you perform substantive analytical procedures and find something you didn't anticipate, are you going to want to follow up on that? So maybe you may not want to. You may say, I really don't want to do more work. Okay. But logically speaking, should you follow up on that? Should you perform more work to make sure you can understand the nature of those transactions? Yes, that would indicate a need for more testing. Okay, so C is our answer. Let's go to D though. D is accrued payroll expense consists primarily of unpaid commissions. That's not something that would cause us to concern. That's just more about the nature of the organization. So I think C is our most likely answer if we're talking about the situation for most likely, because that would actually indicate the need for more testing. All right, moving on to chapter 13. Independent internal verification of inventory, i.e. proper segregation duties occurs when employees who, well, let's just go through. Issue raw materials, obtain material requisitions for each issue, and prepare daily totals of materials issued. Okay. So issue raw materials and prepare daily totals of materials issued. So issue raw materials sounds like custody. Preparing daily totals of materials issued, that sounds like recording. Is that proper segregation of duties? The same person doing that? Probably not, okay? What if comparable records of good on hand to physical quantities do not maintain the records or have custody of the inventory? So somebody who's in charge of authorizing the amounts that are recorded actually maintains the records or have custody of inventory. That sounds like separation of our account or segregation of duties, which B sounds like our answer. All right, let's go to C. Obtain the receipts, transfer completed work finished goods, prepare a completed production report. Okay. I don't see a problem with that, but that's not really segregation of duties right there. Are independent of issuing production orders for payment for a complete job, cost sheets, and production cost reports on a timely basis. I don't see a need for independence there, so that's not really a necessity. The only one that really aligns with proper segregation of duties is B, separation of authorization, recording, and custody. All right. Did I just skip one? I did, didn't I? We were supposed to do 15, weren't we? Okay, my apologies. I'm just I was really excited to get to segregation of duties, guys. Really excited. Okay. Which of the following control activities most likely assist in reducing the control risk related to the occurrence of inventory transactions? So reducing control risk and existence occurrence. Those are both important pieces to note in this particular question, okay? So inventory does not have the ability to record inventory transactions. So we got a segregation of duties issue. Somebody who's responsible for the custody can't actually record inventory transactions. What is the purpose of that separation of responsibilities? So somebody can't actually record inventory transactions and then take them home with them, record fictitious inventory transactions. If I were to say if recording a fictitious inventory transaction, what would you say the risk associated with that is, or what's the assertion associated with that particular issue? Would you say existence occurrence? I would say existence occurrence, okay? And that's why this is the answer. This is A is our answer, but let's go through the rest. So it most likely says summary of the receiving reports is independently compared to the inventory status report. I would say that's a good control, but I think that that would be more about VAA. All right. Inventory is periodically reviewed for slow moving or obsolete items, which may require a write down. Okay. Now this is an interesting one because this does relate to existence occurrence, or actually you could actually make an argument existence occurrence and valuation. I think valuation may be the more logical situation, but does this relate to transactions and events, or does this relate to inventory balances? Balances, and therefore it can't actually relate to controls, okay? Because balances are not relevant to controls. Subsidiary ledgers are periodically reconciled with inventory control accounts. That's pretty easy VAA test, okay? So A is the only one that makes any sense in this context here. All right, 1320. An entity maintains the perpetual inventory records in both quantities and dollars. If level of control risk was set at a high, an auditor would probably do what? Okay, so let's just think about this logically. Control risk is set at high. What are we saying about controls in this area? Are they effective or ineffective, in our opinion? Probably not effective, okay? Because if we set control risk at high, we're saying we can't rely very heavily on controls. What does that mean about our substantive test of details in this area? Are we going to need less assurance or more assurance from them? Yes, we're going to need one of the two. Yes, that was always a problem in some of my examples or some exams. I would not specify to choose one, and I'd say something like, "We would need less risk or more risk," and the answer would be yes. Okay, which I guess technically is a correct answer if I answer that's like quantitative question. But yeah, I'd say choose one. You have to choose one. So I'm going to specify to you all: would that represent less risk or more risk? Choose one. Apparently nobody wants to choose one. Okay, nobody wants to choose one. I'm afraid of the wrong answer. It's a 50-50 chance of me being wrong. It's not a 50-50 chance. Control risk is high. That represents more risk. Okay, more risk. Okay, so if that's the case, that means we need more assurance in our testing. Okay, we need more assurance in our testing. So let's go ahead and work through the answers to see which gives more assurance. Insist the entity perform physical accounts of inventory several times during the year. Okay, that sounds like it's something that'd be really, really good to do. Does that have any relevance on the final balance of inventory if we count it multiple times during the year? No, none whatsoever. Okay, the balance is what it's going to be. It doesn't matter if we count it multiple times. Okay, it's like, okay, I want to make sure that my grade is great in this class, so I'm going to check my grade every single day. Is that going to change your grade in this class? No. All right. Apply gross profit test to ascertain the reasonableness of physical counts. Will gross profit actually validate physical counts? Maybe to some degree, but not really. Okay. Gross profit is based on multiple factors, which includes the value of the inventory, which would not be validated for a physical count. Increase the extent of test of controls of the inventory system. Now, is that a valid approach? If we've already said controls stink, should we increase the extent of test of controls? It's like, you know, the controls are garbage, but we're going to test them further just to make them true. I'm sure they're truly garbage. Okay. It's like, if you already believe that they're garbage, it doesn't really make sense to increase your test of control. So A, B, and C are all out. So we got D left. Request the entity schedule the physical inventory count at the end of the year. So we could do interim testing of inventory or year-end testing of inventory. Which one's going to give us more assurance? The year end, because that's the balance that we're trying to validate, is the year end balance of inventory. It will give us more assurance, and therefore that's going to be a much more powerful test. D is our answer. Does everybody follow the line of logic of that? This one's actually a really good question to test your understanding of what the protocol are in every scenario, walking through the sequence. All right. 1322. When auditing merchandise inventory year, and the auditor performs a purchase cutoff test to obtain evidence that what? So what are we trying to do? We do a purchase cutoff test. And so probably something related to cutoff. So let's just go through our answers. All goods purchased before year end or received before the physical inventory count. Now, that sure sounds like a cutoff issue, but is it possible that you could purchase something and, God forbid, receive it in the following period? It's like, I purchased something on Amazon at 12/31. They are required to deliver it to me today. Okay. Nope, that doesn't always happen. No goods held on consignment for customers are included in the inventory balance. That's something we should validate, but does consignment holding consignment test cutoff? No, that test rights and obligations. We've talked about that a few times already. Goods observed during the physical inventory count are pledged or sold. That's actually another rights and obligations issue. All goods owed at year end are included in the inventory balance. There we have it. Okay. If we have something at year end, they want to make sure that they're included in inventory balance. Want to make sure that anything that's not at year end is not included in the inventory balance. That's the very definition of cutoff test. All right. 1323. Inquiries of warehouse personnel concerning possibly obsolete or slow moving inventory items provide assurance about management assertion of. Now, I said earlier that this could be existence, but primarily speaking, if we're talking about obsolete or slow moving inventory, what is our primary assertion in this area? Valuation, yes, VAA, making sure that the amounts that they're recorded on the books for represents a reasonable amount for them to be recorded on the books on. If we've got boxes of BlackBerry sitting over in the corner, they're probably not going to be worth the thousands of dollars that we say there. It really depends. If they're BlackBerry phones, they're probably worth nothing. If they're actually fresh BlackBerries, they might be worth something, okay, depending on how quickly we get rid of them. Obsolete, fresh BlackBerries probably are not really something we want to be selling to people, you know, that would be awkward. That would be awkward. All right. Oh, yeah, 1332 and 1333. All right. One of these questions I kind of dislike. One of these questions is kind of fun. Okay, yeah. All right, so we got another list of audit procedures and we're going to match them to assertions, which is something that I think is really important to getting familiar with the procedures and the assertions that are related to them. So let's just go ahead. Now let's get down to our assertions and we'll refer back up to here. So we've got 5 assertions and 6 audit procedures. So one of these is probably not going to be included in there. And that is the fact of the case. All right. So examine current vendor, assure that the entity has legal title to the inventory. So we're talking about testing of rights and obligations. Okay. Now, this one's one we've seen before. And there's consistent application of the particular review with respect to rights and obligations. I don't particularly like the test that they actually identify here, but it is consistent with what we saw in the revenues and purchases sections. Okay, so when we actually looked at this back in the previous week, last week's homework, it was consistent with that. Remember, they talked about loan agreements and board of directors meetings minutes for rights and obligations, and it's true here too. Because if we want to know if items should be held under ownership, we want to make sure we can identify what was purchased and who authorized the purchase. Now, the reason I have a problem with this is that it seems like that if we're talking about inventory, that's probably not something that's going to be discussed in the board of directors meetings, or not even through via loans. These seems to be much smaller purchases than the much larger ones we were talking about in revenue and purchasing last chapter. Even so, that's our best answer given the ones that are presented. So we're going to say 6 is our answer. Ensure the recorded inventory quantities include all products on hand. All products on hand. Okay. So we're talking about completeness here. We're talking about completeness. Completeness is a directional assertion, so we're probably looking for a directional test. Which direction does completeness move? Top to bottom, bottom to top. Bottom to top. Okay, so we're talking about a tracing test. Okay, so let's go ahead and look at 3. Select a sample of items during the physical inventory count and determine they've been included on the count sheet. So we're going to select a sample items. We're going to see, all right, here's what was on the floor. Let's compare the count that was on the floor to what's in the on the sheets, which represents the system. So we're going floor to sheet. Is floor to sheet a tracing test? It is. So 3 is our answer for B. Verify the inventory has been reduced when appropriate to replacement cost or net realizable value valuation. Okay. So this one's actually trying to make a determination of valuation. Okay. We're trying to actually determine if we're holding something that is actually representative of what the true cost is. Okay, that was the cost. So again, this is like those blackberries in the corner. We're going to go and look and see what is the market price for those blackberries, and that's the holding value that we need to understand. Okay, so if you've got inventory that's being held, what is probably the best source of identifying what the cost of that inventory is? And I'm not talking about what you purchase it for, not historical cost, the actual value for the inventory, what it should be held at a cost. Could we go to the vendor price list? Yeah, we could actually compare to the vendor price list and we could actually make that determination. So we could say 1 is our answer. Now D is a little bit problematic. I don't like the answer for D. Okay. It says verify the cost of inventory has been properly determined. They actually say that the select a sample of recorded items and examine supporting vendor documents, invoice contracts, which is 4. So that's actually determining that the recorded cost, the historical cost has been properly determined. Okay. Which I do think that that's a reasonable answer. So 4 is the answer the book gives. Could we make an argument that 1 would also be appropriate test here? That's examining the current vendor price list would be appropriate. I think that there's a rationale behind 1 as well. So if you answered 1 for this one, then you could also make an argument for that. That being said, 4 is kind of the given answer. And assuming that we're not talking about outdated or old merchandise that's being held on the books at a much higher price than it should be, or much higher cost, 1 could be a rational approach as well. Okay. All right. E, verify the major categories of inventory and their basis evaluations are adequately reported in the financial statements, which, my goodness. Completeness and accuracy and evaluation for presentation and disclosure. Does everybody understand that fully? Completely don't understand that? It's like, yeah. Now, here's what I suspect happened here is that this is actually a new version of this new question in the book, okay? And somebody saying, we need to assign assertion to this because actually this is the assertion needs to be presented for all of these. And so this was given to an editor and said, all right, make sure you identify the assertion. The editor has no experience in auditing or accounting. And they said, well, I'm just going to use as many assertions as possible because one of those has got to be right, okay? So major categories of inventory and their basis of valuation are adequately reported in the financial statements. I do think there's multiple ways that we can look at this because the basis for valuation implies valuation. Although, yeah, that's it listed there. But primarily, I think we're talking about presentation and disclosure here, or at least something along the categorization of inventory, which might be classification. Anyway, E is kind of really, really weird and confusing. And the interesting thing is that the answer to this is number 2, review the drafts of the financial statements, which is wholly unsatisfying. Does everybody understand why I didn't particularly like this particular problem? Because we get to E and we're just like, what? I don't even know what assertion we're testing. How am I supposed to know the procedure? Yeah. So the answer is don't worry about E. E, if you got that one wrong, there's a 0% chance that question will be asked on the exam. There will be much more clear assertions on that one. So yeah, let's move on to Ando Company. What do you guys think of Ando Company? This is a place that kind of place that you want to work when you leave here and go into the real world? Yes. Okay. So let's go ahead and review. I'm going to read through this and we're going to identify some important information. So Ando Company, a diversified manufacturer, has 6 divisions that operate throughout the United States and Puerto Rico, and who historically has allowed its divisions to operate autonomously. All right. Ando does not have an internal audit department, and corporate intervention only occurs only when planned results are not obtained. Okay. Ando has a policy of hiring competent people. Management is fairly conservative in terms of accounting principles and practices. but employee compensation depends on large part in performance. So let's talk about that last step, okay? So first of all, they don't have an internal audit department, which makes me a little bit antsy already if we're talking about auditing a big company. But employee compensation depends in part on performance. What do we talked about this? We talked about this shape, this triangle earlier in the semesters. Everybody remember that triangle that we talked about? Says, yeah, it was the fire triangle, Dr. Barnes. Smokey the Bear. Only you can prevent wildfires, okay? No, what triangle am I talking about? Broad triangle. What does that sound like to you when we talk about employee compensation depends in large part on performance? So let's say that you're doing your job and they say, all right, you're not going to get paid unless you perform well. Are you going to feel some pressure? Yeah, some pressure upon you to do well. Yeah. So that's an example of a very strong example of a pressure to commit fraud. Now, that doesn't mean that fraud has occurred, at least not in this first paragraph, but we move on. We've got JP Kumar. JP Kumar is the general manager of the appliance division that produces a variety of appliances. Kumar has been able to improve profitability of the division of each of the prior 5 years. Well, that's good management, right? Be able to improve the profitability. Should I continue reading, or do we want to just stop here and call it good? Call it a day. Call it a day right there. Just say JP Kumar is doing their job. There's no need to audit this company. All right. We'll continue on. Much of the improvement came through cost cutting, including a substantial reduction in control activities over inventory. All right, so this is going to be very interesting. So you're going to hear me say this multiple times, but on one hand, this person is nefarious, okay? On the other hand, you just kind of like, bravo, get rid of those control activities to cut cost, and then those same control activities don't catch you committing your fraud. I mean, yeah, if you're going to commit fraud, this is the way to do it, guys. This is the way to do it. All right. This has actually been recorded on YouTube. You can actually go back in the evidence. Who was your accomplice? Dr. Barnes in auditing. Yeah. Dr. Barnes in auditing taught me how to cut controls so I could commit fraud. All right. Recently, a new competitor has entered the market and offered substantial price discounts in an effort to grab market share. Kumar is concerned because if profitability is not maintained, his bonus will be reduced. All right. We don't want his bonus reduced. So he decided the easiest way to make the appliance division appear more profitable was through fraud, manipulating the inventory, which is the largest asset in the books. Kumar found that by increasing inventory by 4%, income could increase by 8%. Okay. So I do want to make sure we have a reiteration on this, and I will draw on the board if necessary, but I'd like to avoid that. Does everybody understand when we talk about the inflation of inventory, how that affects cost of goods sold? So I said that if we're talking about inflating ending inventory, that would decrease cost of goods sold. Now, how does that work? Okay. So the way that I used to explain this back in 221, and nobody will actually have the explanation because nobody took me for 221 in this class, but I call it the base formula: beginning plus additions minus subtraction equals ending. And then you can actually reorder any of those numbers. So the way that you probably figured out is beginning inventory plus any additions would be purchases minus ending equals your cost of goods sold. Okay. So if I'm subtracting ending inventory and I make that number larger, what happens to my result? My result gets smaller, okay? So if I increase ending inventory, I make cost of goods sold smaller, all right? That's basically what's happening in this fraud. It's a very, very basic fraud. This is the same type of fraud that's occurred in many organizations, but it's important to understand why inflating ending inventory would do that, why it would actually result in lower cost of goods sold. Because cost of goods sold is calculated based on what ending inventory is, and you say you subtract a larger number, you get a smaller result. So that's kind of the intuition behind that. So JP Kumar, pretty intelligent, said, yeah, I can actually increase my inventory, and I can actually, that will have a much bigger impact on income. With the weakness in inventory controls, he felt it would be easy to overstate inventory. Again, bravo, just butcher your own internal controls. That way nobody catches you, okay? Get rid of the people who's oversight, which makes me a little bit nervous when they talk about scrapping the IRS and the United States government, but that's neither here nor there, I guess. All right. Employees count the goods using count sheets, and Kumar was able to add 2 fictitious sheets during the physical inventory. Okay. Even though the auditors were present and observing the inventory. What did we talk about? What did we talk about on Wednesday? What did we talk about? The auditor has to control the count. They have to control the flow of information. Adding 2 fictitious inventory sheets, is that something that auditors should be able to should have a problem with? Should they allow that? No. Something we should jump in and say, wait a minute. There's something going on here. I declare shenanigans. Okay. That's actually what I want you to do if you ever come to this scenario in the real world. Somebody comes up to you with 2 fictitious inventory counts. You say shenanigans. That's the official term for it. I remember it from 417. If you don't remember any assertions, just remember the word shenanigans. Okay. All right. Significant amount of inventory was stored in racks at the warehouse because of the heightened difficulty accounting. Then Kumar was able to account an overstatement of inventory in the upper racks. Doesn't sound ridiculous? That sounds like something out of science fiction, right? This is actually a description of the fraud that occurred at Crazy Eddie's appliances in the 1980s. So that the auditors would say, "Oh, that's really high to climb," and says, "Oh, we'll have somebody climb up the racks for you." And so the personnel of the company actually counted the inventory, and they made up complete and total phony numbers because the auditor was just really to worry about climbing on top of the racks to get to the top. So yeah, that sounds like it's crazy, but it's actually true. That's something that happened. All right. After the count was completed, Kumar added 4 additional count sheets for offered $950,000 or 8.6% of the state inventory, notified the emission of the sheets and convinced them they represent overlooked legitimate inventory. So you're done with the count and it says, "Oh, by the way, here's some count sheets that we didn't include here. Forgot to include those, but they're totally legit. Totally legit." Everybody's going to say, "Yeah, that's fine." Auditors retraced these amounts to the sheets of the purchase invoices to verify their existence and approve the $950,000 of inventory. All right, let's think about this statement here. The auditor traced these items on the additional sheets to purchase invoices, okay? All right, so is that actually correct use of tracing? It is, okay? It is a correct use of tracing. Let's look at the rest of the statement. To verify their existence. Does tracing verify existence? So if auditors did perform a tracing test, did they verify the existence of the inventory? No, they just verified that invoices are in place to actually show that inventory was purchased for that. Could it possibly be a chance, just bear with me, that JP Kumar made fictitious invoices? Is that a possibility here? Given what we know about JP Kumar, who's a very brilliant and ethical individual, okay? We did not verify we did not verify existence here. We did not verify the existence of inventory. We verified the completeness of the transactions. Tracing verifies completeness. So assuming it was going in the right direction, which it was, that was a problem because that was the whole goal. We had to verify the existence of inventory. The auditors did not do that. They did not validate that. All right. They approved the addition of $950,000 of inventory. They did not notify management of the added sheets. In addition, Kumar altered other count sheets for sending the auditors a changing unit designation. For example, 6 motor mounts became 6 motors, raising counts, adding fictitious line items to the completed count sheets. Fictitious changes added $375,000 to the inflated inventory. None of this was detected by the auditors. All right, so here's what I would like to do, okay? Knowing that the JP Kumar was completely and totally unethical and was doing this for their own benefit, let's just admire the brilliance of this particular fraud scheme. A round of applause for JP Kumar. Yeah, well done. Well done. If any of you ever goes to prison for committing a white collar fraud, I hope that your fraud is at least as well orchestrated as this one right here. Okay. I will say I'm disappointed in your ethics, but I'm very, very proud of your intelligence and your enthusiasm. Okay, and I will hold on to that. All right, so let's go ahead and go through the answer questions here. What audit procedures did the audit apparently not follow when that should have detected Kumar's fraudulent increase of inventory? So keep in mind that we've actually got 3 points here that need to be identified. Okay, there was the inventory count issues itself. There was the subsequent there's the subsequent addition of the inventory sheets as well as the modification. Technically speaking, it could be 2, but we'll talk about all 3 of these. Okay, what happened during the inventory count that was really problematic? Probably the most important one. The addition of the 2 count sheets. Okay, those additional count sheets that were added to there at the last second. So how do we verify that as auditors? Because we don't know where this is supposed to come from the system. When we get the inventory count sheets, we probably want to validate this is information from the system. And JP Kumar says, "Oh, count sheets." And I say, "Well, does this come from the system or not? We don't have time to validate that." So they didn't validate the information that's on the count sheets. Also, climbing up the racks. Should you climb to the top of the racks to do the count yourself if you're test counting inventory? The answer is yes for all of you. Okay, I don't want to hear it. Okay, if I had to climb up those dang drums in the middle of winter in Oklahoma, every single one of you has to climb to the top of racks and count inventory. Okay, does everybody understand right now? If I hear that you were just like you let a fraud happen because you just didn't want to climb to the top of a ladder, I'm going to call that company that I had to audit. I'm going to say, I've got an auditor that needs to come and visit you, and I'm going to send you out there, even though I'm not authorized to do so. Make you climb those drums just to actually experience that. And you're going to say, I really wish I'd climbed those racks. Dr. Barnes is a vengeful Lord. All right. Yes. Okay. We do need to climb those racks. Okay. So that's the first one. Secondly, the fictitious inventory sheets. This is a massive red flag, by the way. This is probably the biggest red flag, the additional 4 sheets that were not counted. So in addition to not knowing this is part of the system, This was not even part of the legitimate count, so we don't have any ability to validate that. What do we call it when we can't perform testing over something? What is that referred to here in auditing? 2 words, scope limitation, okay? We should be very, very wary of anything that we can't validate. Now, they did try to validate that, but is there a problem with that validation? Yes, we've already shown that. They did not do correct directional testing. They said, oh, let's look at the invoices. The invoices say that they were received, so obviously that validates the inventory. No, it doesn't. It just validates there's documents that were sent for the inventory. We need to verify the existence of the inventory itself. What's the best way to do that? Go and count that inventory. Go and count that inventory. All right. And then the changes to count sheets. Those should have been ones that we'd be very, very scrutinizing because those are going to actually result in a material amount. So auditors basically failed on every level here when it's very, very obvious that there were problems here because we already know an existent pressure is there. Now, can the auditors be wholly blamed in this situation? Yes, we should blame the auditors for everything. Yes. Okay. Obviously, the scrapping of the internal controls is certainly problematic. And the fact the organization puts such emphasis on bonuses. But an unethical individual does need to be, we need to be aware that if somebody's unethical, they would actually take these means, those mechanisms. What the implications would there be to an auditor to failure to detect material fraud as described here? So this is a little bit outside of the scope of what we're going to be testing on, but we do need to talk about this. If you fail to detect a material fraud, can you as the auditor be held liable for that? Answer is yes. Okay. Yes. Okay. Now that criteria is not nearly as stringent as it used to be. If we're talking about in the 1990s, if you were found negligent or reckless in any shape or form, then you can be held jointly and severally liable. Which go talk to Professor Templeton what that means. That's a bad thing. Okay. That means that if your client can't afford to cover the penalty, that you as the auditor have to cover the remainder, which sucks. Okay, it's like going out to dinner with me and saying, "Oh yeah, I didn't bring my wallet. Yeah, you're gonna have to cover the meal because I eat a lot of food, guys. All right, yeah, eat a big meal. All right, so that would be the example of that. You're not responsible for just what's yours, but you're responsible for what's mine as well. That doesn't exist as much anymore. The Private Securities Litigation Reform Act changed that, but it still could be if we were negligent as auditors, then that we'd be responsible for some sort of penalty associated with that. So we can be held liable. What's the bigger concern? Is the money that we pay out as auditors, that fine that we have to pay to the SEC or to the PCAOB, or that we'd have to pay to stakeholders? Or are there reputation risks that we would be associated with that as well? Okay. Like if you screw up in a class, if you get caught cheating, okay, are you going to be worried more about the grade, the grade that you're hit with, the loss of the points in that class? Or are you going to be worried about the reputation that you now have at Truman State? And it's like, this person's a cheater, okay? This person's a cheater. That's really, really much bigger concern, and that's the bigger issue. It's kind of the reputation associated with that. According to the audit standards listed at the start of this chapter, which responsibility auditors have to discuss their concerns with the entity's audit committee? Okay. So did we identify red flags in this? The answer is yes. Okay. So at minimum, what should have been some of the discussions that they had with audit committee? Some of the unusual circumstances of the inventory count. That probably should have been something we come up with as well. We tried to conduct an inventory count, and our inventory count went reasonably well. However, we had multiple instances of count sheets being added on that we could not validate. So we don't know if that's a true actual representation of inventory. Also, we suspect there may be some manipulation of amounts or items within the records themselves. That's a possibility. Is that the only things that we'd have responsibility for as auditors? Just what happened in the inventory count? I mean, that's obviously something we would want to talk to the audit committee about. That's obviously something that we need to discuss with management, and the audit committee just needs to be disclosed because they're big issues. But what are some other concerns that we've identified in this case? Okay. What was one of the very first things that we talked about? What is this situation with their audit department, internal audit department? It's great. Okay, they have objectivity, competence, and systematic and disciplined approach, right? They would if they existed. Okay, is that something that we want to talk to the audit committee about? It's like, if you're a publicly traded company in the United States, and even if you're not, it's a good idea to have an internal audit function because you can't validate a lot of these things. You can't ensure the proper operation of these controls within this framework. Also, cost-cutting measures. If we identify the controls are being cut, does that make our job easier or harder as auditors? This should be a gimme by this time, guys. Less controls means more work for us. Okay, it means it also means not just more work, but more chance for issues, okay? More chance for issues if internal controls don't exist. So we say cost cutting due to, or cost cutting controls to try to actually meet bonuses. That may actually look really good on the bottom line, but that's really, really disastrous in the future. Now, there is that argument saying, well, if the controls themselves are not worth the benefit, but we already have knowledge that controls should be implemented into the places they should be worth the benefit. And plus, we've identified a particular gap in here, which again, I was joking when I was saying bravo to JP Kumar, but that's kind of a self-fulfilling prophecy, don't you think? If you can cut controls and then you use those same lack of controls in that area to commit a fraud, that certainly seems to be problematic. So this is a fantastic case for identifying a whole logistic picture where you have to look at details, but you also have to look at everything as it aggregates together and be able to analyze this. And with respect to how this operates within the framework of an audit, if you run into a client, this is in the real world, this is one where you need to be going and talking to the partner and talking to your superiors and saying, there are problems here that I can't reconcile and these need to be reconciled to some degree, okay? But yeah, like I said, massive failure on the part of auditors. It sounds like this is a fictitious case, but it does have elements from real world cases that sound really crazy. But all of these situations have happened in reality and in truth in other scenarios. I don't believe this is a real company, but it's based on real companies that have happened. All right. That does it. Let's call it good and we'll wrap up our lectures next week. Have a good weekend.